Yahoo mum on sale as it misses, writes down Tumblr. With a possible new buyer waiting in the wings, Yahoo's quarterly financial report showed it's become a smaller company struggling with falling sales and the hangover from a past, pricey deal. Anyone hoping for a word on the auction of its core internet assets was disappointed. CEO Marissa Mayer said there would be no update on the process during a call with analysts Monday. "We are making great progress, and will update as soon as it's prudent," she said. The Sunnyvale, California. BASE The Internet Media Company reported non-GAAP first quarter earnings of 9 cents, missing expectations of 10 cents per share, based on analysts polled by S&P Global Market Intelligence. That's down from 16 cents in the same period April-June 1 year ago. Revenue minus the cost of traffic acquisition was $842 million, beating estimates of $836.8 million and within Yahoo's guidance of $810 million to $850 million. Yet that's down about 20% from the same period a year ago. $1.04 billion. The company reported a net loss of $440 million, wider than a $22 million net loss 1 year ago. Yahoo also wrote down the value of Tumblr, which it acquired 3 years ago for $1.1 billion and had already written down by $230 million earlier this year. For the quarter, Yahoo took a non-cash goodwill impairment charge of $395 million and a non-cash intangibles impairment charge of $87 million for a combination of factors, including decreases in our projected Tumblr operating results and estimated future cash flows, the company said. Little appeared to surprise investors, who sent shares a fraction lower in after-hours trade. Monday also was expected to be last day that Yahoo would accept bids for interested buyers of its core business. 4 months ago, the company began exploring strategic alternatives that could include a sale of its core business, which includes advertising, search and content such as Yahoo Finance, Yahoo Sports and Yahoo Mail. That strategy arose was the urging of Starboard Value and other activist investors in the wake of Yahoo's abandoned plans for a spin-off of its stake in Chinese e-commerce giant Alibaba. Yahoo's board deemed the transaction too risky because of potential tax liabilities. Smaller Yahoo Mayer on Monday focused on the fact that the company's cost-cutting measures, begun earlier this year, were having an effect. The company's headcount had been reduced from 11,000 during the April-June period last year to 8,800 a year later, resulting in the lowest headcount and cost structure in a decade, she said. "We have made some difficult decisions," she said. "Overall, it's really resulted in a very efficient, responsibly run corporate Yahoo. For the products we are focused on vertical line, this is the right size for the company." Before taking into account costs of traffic, Yahoo revenue rose nearly 5% to $1.3 billion. Revenue from the company's mobile, video, native, and social business mavens rose 26% to $504 million. Yahoo YHOO shares slipped 0.3% to $37.85, after closing at $37.95. when asked about her expectations to ultimately separate the company's 15% stake in Alibaba, valued at about $31 billion. Mayer said that the ongoing strategic process was meant to essentially kill two birds with one stone, both achieve the Alibaba asset separation vertical line while also lighting up the core operating business for the Internet with a good strategic outcome. Earlier in the day, former Yahoo CEO Ross Levinsohn described the 4-month sales process as kabuki theater while being interviewed on CNBC. He had been among an investment group including Bain Capital and Vista Equity Partners that dropped out of the Yahoo bidding process. The company, which isn't likely to announce the sale results until the beginning of August, is troubled, clearly, he said. However, the core of it, I think, is still fantastic with great people, terrific brands. But the focus of where they invested what amounts to about $9 billion in buybacks, perks and acquisitions just has not paid off. Follow Mike Snyder on Twitter, @MikeSnyder.